Hi there. My name is Marc and I'm from Nordic Markets and here to help you make sense of how the markets have moved so far at the beginning of the 2025 calendar year and where we're headed into the new year.
Awesome. Awesome. Thanks, Mark, and thanks to everyone for joining us. I think one thing I'd like to add before we get into the presentation is for me, this mid year really does feel different from previous years. I mean, we've got some markets behaving as if we're in as a flashing late cycle risks like the yield curve and commodities. So for me, right now, it's not really purely just being about bullish and bearish. It's about being adaptable and also tactical. But with that being said, I think let's jump straight into the presentation where we can expand further.
Great. So today's topic is Sizzle or Fizzle, the midsummer market heat check. So as we've reached the midpoint of the year, markets are at a crossroads. Inflation's evolving, central banks are recalibrating, and geopolitical shifts are reshaping the global investment landscape. We want to thank you for joining our comprehensive midsummer market update, where Oscar and myself will review year-to-date performance, examine some winners and laggards, and discuss the key risks and opportunities heading into the final two quarters. We hope to equip you with the insights you need to position your portfolios for the months ahead. So I think the best thing to do is to start with the global outlook. So let me share the screen here. So as you can see, we've had pretty good growth beginning of the year, and it's expected to continue on into 2025 and 2026. However, there have been some downgrades to the forecast by the OECD. And as you can see, we've gone from initially expecting a 3.3% growth to 2.9%. So a slight downgrade. Not surprisingly, and this follows a trend that we've seen over the last few years or decade really, the advanced economies are showing weaker momentum, with the US and Euro area struggling to crack 2%, while the emerging markets, particularly India and China, are still the primary engines of growth. Oscar, what do you say to that?
Yeah, I think you're totally right. Like you say, global growth forecasts have been downgraded, but I think the nuance here is how investors are treating different regions. So, on one hand, we've got the market rewarding countries with strong domestic demand, like India, for example, like you mentioned, where growth is still above 6%. Meanwhile, economies reliant on global trade, like Germany, for example, are struggling under the weight of tariffs and also weaker exports, right? So I think this divergence is important because it creates opportunity. So for me, I like India and parts of Southeast Asia, where consumption is really driving growth at the moment. But I would stay a little bit more cautious on Europe until we see clearer signs of recovery. I mean, even within emerging markets, I think selectivity is key right now. India, for example, over Brazil, where, of course, policy credibility is still an issue. But yeah, for me at the moment, I think it's important to understand where monetary flows are moving. I think that's into, like you say, emerging markets over our key economies.
Yeah, we'll talk about central bank action in just a minute, but I think the one thing I'd like to add to your comments, so I totally agree, India will be a massive growth driver, but like with anything, there's expectations and reality. So obviously a country like India and China, because of their high growth rates over the past decade, have a higher hurdle rate, as it were, to surprise. And hence, for the markets to perform, not only do they need to achieve a high number, but maybe even need to surpass that. Whereas, as you mentioned, Europe and Germany in particular has been a laggard. So the base expectation is so low. So all it takes is a slight uptick or a slight improvement compared to a very low expectation, and you can actually see those markets in Europe perform really well. And that's actually sort of what's happened in the first half of this year. No one's expecting Europe to outperform India or China on an absolute basis, But on a relative basis, actually, Europe has had a bit of a positive backdrop due to, I think, Donald Trump's insistence that Europe needs to pull its own weight in terms of spending on military and defense and pumping up their economies and less of a reliance on the U.S., as has been the case over the past few years and decades, really. So we always, like, as investors, we always have to look at expectations versus reality, and that'll be the key driver to either outperformance or underperformance.
Yeah, for sure. No, I totally agree.
So now let's pivot to your next point, which was what are the central banks doing? So
Hmm.
obviously, central banks are a key driver of the markets, right? In terms of what they do with interest rates and with monetary and fiscal policy. So there's been a bit of a divergence, as we can see here. The Fed's walking a tightrope, where they're trying to obviously keep inflation in check, especially with this backdrop of increasing tariffs. Um, and the ECB, on the other hand, is a bit more in hawk mode, while Japan, after decades of deflation, is finally starting to increase rates after having a long period of negative rates. So, as we know, markets aren't just driven by the big macro headlines, but really by liquidity. And this is where the central banks will play a key role. So now the key question is going into the second half of this year is, will the Fed cut rates? What will the ECB do? And what will Japan do? So Oscar, what are your thoughts on that?
Yeah, for sure. I think if you look at the Fed, yes, they've held high rates, right? But behind the scenes, they've slowed balance sheet runoff, which has provided a backstop for risk assets. So one I wanted to mention here, which I think is a big under the radar story, especially for the retail market, is Japan, like you mentioned, because of course, we've had decades of ultra loose policy, and now we've started to see a shift, and they've started to normalize, which means for Japanese investors who are some of the biggest buyers of treasuries, as we know, they're bringing money back home into Japan, and I think that capital shift back to Japan is almost a stealth headwind for the US dollar and even US equities potentially moving forward into the remainder of the year and into 2026. So for me, a key point here is not just what the central banks are saying, it's also where the money is actually flowing, and that's a key thing which I'm going to be watching over the remainder of the year. But I think on this topic, talking about central banks and economic data, one thing which might be worth discussing for the viewers is the recent PPI report, which came out last week, which shocked the markets, right? With headline PPI increasing, I believe it was 0.9%
That's right.
month on month, which, from my understanding, is the hottest print we've had in some time, right? It's been sort of 2 or 3 years since we've had a print or an increase that high. So, yeah, I think when we consider their sort of sticky service price increases in sectors such as vehicle wholesaling, car rentals, internet services, tariffs are only going to make this situation worse. And the thing for investors to consider here is that pipeline inflation, which, to put things simply, are input costs businesses can't absorb forever, right? So either they'll pass them to consumers or they'll eat into profit margins. So despite this surge, Fed fund futures are still pricing almost a 90% chance of a cut in September, which shows me that there's a disconnect, which couldn't be clearer there. We've got inflation pressures which are re-accelerating at the producer level, but markets are still clinging to a dovish narrative. And we kind of saw this in the reaction, right? Yields jumped, the dollar rallied, small caps like the Russell sold off, and Bitcoin hit a record day intraday high, which reversed sharply lower pretty shortly after. So for me, the big takeaway here is that the market is betting on cuts, but the data could be beginning to move the other way. It's just a contrarian point of view unless inflation rolls over fast. So yeah, what I'm looking at short term is really Jackson Hole, and I think that could be the moment that the Fed pushes back against the easing narrative, potentially. We'll have to wait and see. But I think the next to 5 weeks are critical when we're considering economic data. What would your thoughts be on PPI, Mark?
Well, I would actually encourage all of our listeners and viewers to go on to our various socials, because we put out 2 videos over the past week or so on exactly those 2 topics. The CPI that came out, I want to say about a week and a half ago now, and the PPI, which just came out last week. And as you rightly point out, there's this divergence. CPI was relatively tame, but the PPI, which is producer price index, which is obviously more the upstream cost, has reached multi-year highs. So it seems like even though tariffs haven't quite made their way into the final consumer prices that you and I might end up paying, they're starting to make their way into the manufacturing side, which will obviously eventually probably feed down to the consumers, because retailers and producers can't absorb those costs forever. If not, that'll severely eat into their margins. So as you rightly point out, Jackson Hole is going to be key. I think that's in September. Do you have the date there, Oscar?
I don't have it to hand. I can
Yep.
quickly check.
But you're right. It is that'll be a key date, because there has been a big assumption that the Fed would start lowering rates starting in September. But with this PPI print, certainly throws a little spanner into the works. The other thing, I think, we're not going to spend too much time on it today, but it's the housing market in the U.S., where it's obviously driven a lot by interest rates, and the mortgage rates. Even though the Fed did cut rates last year and beginning of this year a couple times, the mortgage rates have not fallen. They've actually, if anything, stayed the same or even risen. So as a result, you've got this housing market in the U.S. which is at a standstill, because people don't want to sell, because a lot of them are locked into lower rates. And on the other hand, people can't afford to buy necessarily because the mortgage rates are quite high. And so as a result, you've got these prices which on the headline don't seem like they're falling much, but really I think the real estate market's at a possible tipping point, which could obviously lead to major negative consequences for the US economy. So the Fed really has to balance this inflation mandate versus the fundamentals of the economy, which on the surface seems strong. Real estate prices all-time high, stock markets all-time high, crypto prices, as you mentioned, all-time high. Everything seems like all systems go, but really underneath, it's not as clear as one could think. Which actually brings us to the U.S. dollar, and I'd like to show this chart. And I know, Oscar, you've got major thoughts on this in terms of the U.S. dollar this year. So what you can see here on this chart is how the US dollar has moved over the last 5-6 years since 2020. And the blue line all the way on the bottom there, where it's showing minus 10-11%, is what we've had so far this year as of yesterday, whereas all these other lines are how the US dollar has moved in these previous years, depending on the color. And as you can see, we're down 10-11% this year on the US dollar, which is actually, even though here we only have 5 years worth of data, it's actually the worst start to the US dollar since the 1970s. So terrible start for the dollar, and that's obviously one of the key things that we all look at as investors in terms of the health of an economy. So, Oscar, what's your thought as a FX expert on the dollar at the moment?
Yeah, I think one thing that's probably overlooked by the retail market is, well, first of all, we've got the US fiscal deficit, where foreign buyers are becoming less willing to soak up US debt unless yields are higher. And the thing is that undermines dollar demand, right? Which is a reason why we've seen this sell-off. And secondly, we're seeing capital rotation, like I mentioned previously, into Asia, where returns are more attractive in the short term. So it's difficult, and I think we're at a bit of a turning point at the moment. And I'm going to share my screen shortly, just to show all our listeners what I'm referring to here. But I think in the short term, the dollar is extremely oversold. Like you say, this is the sharpest decline which we've had over the last 5 years, year to date. So I wouldn't be surprised to see some tactical rebounds here. But
And actually, we have, right? There's been a little bit of a bounce over the last few weeks, right?
yeah, for sure. Let me share my screen and I can show the viewers what we're both referring to here. So what you guys should be able to see in a second. Mark, can you see my screen?
I cannot. I'm still seeing just the two of us. Ah, there we go.
Awesome. Okay, cool. So yeah, what we've seen here, and I've been kind of observing the Dixie pretty close over the last couple of years, right? And one thing I note is we're in this, well, back since the financial crash in 2009, we've been in a 18-year rising channel here on the DXY. And one thing I've been analysing is every time we come back down to this lower bound of this channel, if we look at the commitment of traders data at these respective points, right? We've got in March 2018, COT was 57% short and the market rallied 15%. Again, in January 2021, commitment of traders data 58% short, market rallied 26%. And again, we've come back down to this lower bound. So like you say, if we zoom into the chart here, we're on the weekly time frame for the dollar index here. But you can see we did have a slight tactical bounce here, right at that lower line of this upward channel. So for me, I'm being a little bit cautious because I think the macro narrative, yes, is still bearish for the dollar. But like I say, I think we're in a bit of a swing point here. And yeah, the dollar is losing its, I guess, exceptional yield advantage. So my bias moving forward in terms of the FX market is really to fade rallies and look for Euro US dollar for long positions to grind higher over the next year. So just to show this, I mean, this is a couple of trades which I'm in at the moment. So I took a long position here off of Fibonacci retracement, and I've scaled into this position more recently, and I do expect euro dollar to continue to. I think the way to describe it is grind higher. I don't expect a strong bullish move, but I think it's a pretty safe, or safe as you can get in this market, bet on dollar weakness.
Oscar, can I just interrupt?
From a macro perspective, when it comes to euro dollar, the story. Yeah,
Hello? Oh, sorry. Oscar, I just wanted to ask you, obviously
Marc, can you hear me?
Yes, I can. The question with the dollar weakness and it continuing, I like your idea of fading into strength and slowly, adding to longs because you think it'll quote unquote grind higher. But this does seem to be a relatively consensus view. I believe Morgan Stanley expects the US dollar to weaken by about 10% by next year. So I'm just wondering, how are you worried at all that this has become a bit too consensus, a bit too overplayed by investors at this point?
Yeah, I mean, I think it's a valid point. Like you say, we are seeing consensus long positions at big institutions, most notably JP Morgan, Bank of America, Morgan Stanley. To me, that suggests dips are likely to be bought in the euro dollar. So I'm not overly concerned. I mean, I think when it comes to the euro dollar in particular, the story is increasingly about policy divergence. So, on one hand, we've got the Fed still at 4.25% to 4.5%. The markets are pricing in, like we discussed previously, over an 80% chance of a September cut. So, we've got Fed speakers have been acknowledging slowing growth and softer inflation, which points towards accommodation. That weakens the dollar's relative yield advantage. And then on the euro side, the ECB remains cautious, but inflation is holding around 2%. So I think for me, the key things I'm looking at moving forward is the upcoming data, especially German GDP and the September CPI prim. And if they hold steady, the ECB may not ease as much as markets expect, which leaves room for euro resilience. But yeah, I'm not overly concerned right now. I mean, I think, like we said previously, Jackson Hole's a key thing I'm looking at, and looking at forward data. One thing I mentioned in our introduction is I'm trying not to be overly bullish or bearish on anything right now. My key moving into the remainder of the year is to stay very adaptable, and if we have data upsets or anything like that, I'll be pretty quick to change my mind on certain trades like this. I think that is a key point because, like I say, I think we're moving into a turning point in the market where things could go either way. So yeah, to answer your question, I'm not overly concerned, but yeah, right now the key for me is to stay adaptable with trades like this.
Sure. And actually, so obviously we've got the central banks who are clearly big players in terms of driving the the U.S. dollar and its move. But what about if we go to the big story of really the last since April, the tariffs. So we've obviously had a lot of tariffs announcements since the since April, since that famous Liberation Day. But then since then, we've also had this coined phrase called the taco trade. Trump always chickens out. And again, I'd encourage our listeners and viewers to watch our video on that topic. But just as a brief recap of what's happened this year, once Trump came into office, metals tariffs were put on right at the beginning of the year, but then since then, it's really been a lot of news since April, May, where tariffs are on, tariffs are off. And so what we've seen is there's been some negotiations with Europe. A framework was achieved there. And the same thing with China, although they did extend the tariff deadline by another 90 days in August. So our question is the taco trade still valid? Because clearly it's been a great trade to put on. Basically, the minute something is announced, markets react one way, and then if you go the other way, you probably would have benefited quite quickly over the course of the next few days and week as the Trump administration reverses course. So the question is the trade still valid? We think that it will still be valid for the rest of this year because it still seems like Trump has his eyes firmly planted on the markets. But strategically, eventually, as we sort of highlighted with the PPI earlier, these tariffs are being set at a higher rate than what they were a year ago. And so eventually that will probably feed through to prices. And so as a result, both inflation and supply chain will start realigning. So how do you think that might affect the markets going forward here, Oscar?
Yeah, I mean, like you referred to, tariffs are back. But for me, it's not just about trade headlines. Quite frankly, they're inflationary, right? So
That's
even
right.
when tariffs get warped back, supply chains don't just snap back overnight. So instead of thinking strictly about tariffs as a short-term risk, I think of them more as a structural tax on the global economy, right? So for markets, that means sticky inflation, which keeps central banks cautious. It also, I guess, supports commodities like copper, aluminium, and puts the spotlight really on, like we said before, emerging economies, right? Like Mexico, Vietnam, for example, which are clearly winning from supply chain realignment. So, I mean, to be honest, it's not really a trade which historically I've placed the taco trade. It's not something that I've used. I know within institution it's something that has a lot more focus on, but yeah, for me, I like to ride more of the narrative rather than, to me, I guess that the taco trade is essentially a bet, right? And I think at some point, like you say, that those odds are going to run out. So I think the longer this goes on, the likelihood of the taco trade still being valid decreases. But yeah, I'm really focusing. Like I say, my core principle with my own personal trading is really looking at the data. So depending on how it affects markets, and like we said, it's an inflationary, I guess, bias towards the markets. Then yeah, I'm not really focusing on it particularly myself as part of my strategy.
It's interesting because from my perspective, I do like to, I guess a little different view than you here. I like to go with the momentum or go with the story as long as it's not broken. If it ain't broke, don't fix it. So this taco trade, you're right, and I firmly believe it as well. Hence, I mentioned it will run its course at some point. But until it does, it's sort of like the hot hand if you're playing poker or if you're in some sort of, a basketball player shooting baskets believes that he's going to make it the next time after he's made the previous three shots, for example. So I tend to like that strategy in investing just because it works, and then eventually it doesn't work. And so then at that point you have to realign with the fundamentals and the new narrative, exactly what you and I have been mentioning over the past 20 or 30 minutes here. Now I do want to move on to the equity markets because in our intros you highlighted some equity markets that you liked, and clearly that's a trade that has had momentum. A lot of markets globally are at or very, very close to all-time highs. Japan, as we mentioned earlier, its market literally after peaking in 1989 and taking until April of last year. So literally, we're talking 25 years of no real movement. Well, big movement, but no all-time highs. And finally, it's gotten there again, and just in the last few days has reached all-time highs. The U.S. markets continue to defy expectations, and that's been a big talking point where the U.S. market is just continuously reaching all-time highs, yet it seems to be relatively expensive. As we can see here, the S&P 500 is trading at over 22 times forward earnings, which is well above its long-term averages. I think the only time it was greater than that was during the NASDAQ bubble of the late 90s, early 2000. Even in Europe, we're reaching all-time highs. Yet on the flip side, there the PE ratio is much lower, and that's been one of the reasons why the European markets have started to see a little bit of love from investors this year. Yet on a fundamental basis, sort of like what we mentioned at the beginning, it's all about reality versus expectations. And the US market still continues to perform really well compared to its expectations. The earnings per share have been much higher than the 10-year averages, whereas in Europe it's still relatively low. So the question is at least for the two main markets here, US and Europe, seems like the US has continued momentum. And obviously all the big drivers in AI, the vast majority are located in the US and actually in California, if we really wanted to drive in a little bit more deeply. Whereas in Europe, we've got the cheap multiples and we've got these fiscal defensive tailwinds. So those are the two main markets. But I know you, Oscar, do you want to talk a little bit more about those other markets like India and other emerging markets that you were discussing at the beginning?
Yeah, I mean, India's not one which I don't personally trade, but I am keeping a close eye on. Um, I think the Japanese stock market, the Nikkei, will continue to see um, capital inflows. It's kind of, I don't want to repeat myself from what I said earlier, but we are seeing capital rotation back into Japan, and with Japan on its journey back towards normalization, I do think we will continue to see those flows. I think one thing which I guess is probably a bit of a contrarian view here is, US valuations to me look stretched. I mean, currently, if I'm right in saying, I think it's 22 times forward earnings
Yeah.
right now, which for me is extremely rich, right? And considering global investors are still heavily overweight US stocks compared to Europe and emerging markets, I think even if a small fraction of those flows rotate, then Europe and emerging markets can re-rate higher without needing earnings upgrades. So, like you said, it's about even a very small change, I think, could be, a big driver to start seeing these flows rotate into Europe and emerging markets. And I
Can I,
would
can I,
expect,
Oscar, can I
yeah,
just add one thing about that US? You're absolutely right, and I've mentioned in the slides, and you reiterated how the valuations are rich, but we really have that two-tier market. I think most people will have heard of the Magnificent Seven, the Mag Seven, these big tech stocks that are obviously leading the charge in AI, and those stocks are trading at very, very high multiples. Um, However, on the other hand, they're also benefiting from this massive investment in AI. So there is a positive tailwind for those companies. Now the question is the rubber band being stretched too far? But then if you look at the S&P 493, as we often call it, all the other stocks aside from the Max 7, those multiples actually aren't as stretched just because they've been lagging really those big tech companies. So the question is with this super concentration, I think the Magnificent Seven obviously have now a disproportionate weighting in the S&P 500 at well over 40%. The question is can the market continue even if maybe those stocks don't do quite as well just because of their valuations being so stretched, and can that other S&P 493 prop the market up? And so far it's been a case where that is happening because the S&P continues to flirt with all-time highs every day, but that's a big question heading into the second half of this year.
yeah, I think if growth holds up for that magnificent seven, as you refer to, we could start to see a rotation into cyclicals like financials and industrials. And on the other hand, right, if growth cracks, I would expect, of course, defences, healthcare, utilities to start to take a bit more leadership. So I think that's the decisions that investors face heading into Q3 is what way that goes, and the key thing is going to be looking at earnings off that Magnificent Seven group of companies moving into
Actually,
the second half.
did you see the news that Warren Buffett, obviously most famous and successful investor probably of all time, uh, just added to or bought into United Healthcare Group (UNH)? So that
I missed that one, yeah.
yeah, so Berkshire Hathaway, Warren Buffett's holding company that he does his investments through, has famously raised over $300 billion worth of cash by selling off a lot of equity holdings over the previous 6 to 12 months, notably in Apple, one of the Mag 7 stocks. And just this past week, it was announced that he bought into UNH, and that led to a massive rally in that stock. For those that aren't aware, that's the famous story where the CEO got shot in New York earlier this year because the person who was against him or against the company thought that they were gouging in terms of pharmaceutical pricing. So the stock has been on its knees really, and Warren Buffett, famous value investor, believes that there is some value to be found in these other industrial slash pharmaceutical names.
Mhm. No, for sure. No, that's very interesting. I'll do a little bit of research on that after this stream. But yeah, thanks for pointing that out, Mark.
Why don't we move on now to fixed income in terms of the yield curve, because that's obviously a big area of focus for investors. So, despite all these possible landmines like tariffs and geopolitical shocks, spreads, that means the yields of both high yield and corporate investment grade are relatively tight compared to treasuries. And that's because the economy, as we had mentioned earlier, still seems to be doing relatively okay, and default rates are pretty low. But we do know that there's a massive debt wall coming due over the next 6 to 12 months. And as a result, we've finally started to see the yield curve steepen a bit after it had actually been inverted for a lot of the previous 12 months. So the question is where do we go from here? Will the steepening continue as the Fed possibly cuts rates, or will we go back into inversion, which often is a precursor or at least a a symbol of the economy slowing down and GDP contracting? What are your views there, Oscar?
Yeah, I think credit markets look calm on the surface, maybe too calm potentially. I think there's a wall of refinancing coming in 2025, moving into 2026, and a lot of companies that borrowed cheaply over the last few years will be forced to roll that debt at much higher interest rates, and that's going to test balance sheets. And it could be where stress first appears if growth slows, which kind of bounces back to our previous point, right, on the Mag 7 and on the US equity market. I think, like you mentioned, on the government bond side, the question is the yield curve. So, like you say, previously it was inverted. Short-term rates were still higher than long-term rates.
I'm just
And
going to share a screen, by the way, on this yield curve. So this is the 10-year minus the 2 years. So as we can see here, up until the beginning of this year, we were into negative territory, meaning inverted, and we've just bounced into the positive over the last 6 months or so. Oscar, sorry, continue.
yeah, yeah, for sure, for sure. And at some, like you say, that at some point that inverted yield curve had to flip. I think if Fed cuts hard, short end yields will of course fall and the curve will steepen. But then on the other hand, if inflation and deficits push long end yields higher, the curve can steepen, but for almost the opposite reason, right? So either way, it's important, I think, to keep tabs on the shape of the curve. And that means, how it's going to move. That means opportunities. For me, the safer play is owning short duration investment grade credit for carry, while using yield curve trades as a hedge against policy surprises. So, like one simple example of this for our listeners could be the steepener trade. I'm sure, Mark, you've heard of this before, right? But for our viewers, this is basically going long 2 year treasuries, which benefit if the Fed cuts rates, while simultaneously going short 10-year treasuries, which are more vulnerable to inflation and deficits. So if the curve steepens in either direction, that trade can work out. And it's a way of positioning for the shape of the curve moving forward rather than just the level of rates. So that's something I'm sort of considering, and a trade which I've been taking advantage of for the first couple of months this year. And I'll continue to hold that bias until we start to see a change.
Great. Now let's pivot to going away from one of the oldest markets in the books to one of the most recent, if not the most recent, digital assets, which obviously have been all the rage over the last 6 to 12 months, again, since Trump got elected, which has led to a massive rise in the price of Bitcoin and other cryptocurrencies. So this is the year that Bitcoin ETFs went mainstream. We now have over 1.1 million Bitcoin that are sitting in various ETFs. That's 5% of total supply. As you might recall, there will only ever be 21 million Bitcoin printed. But it's not just retail investors and institutional investors. It's also banks that are shifting by offering tokenization of assets, of traditional assets. And then corporates, a lot of corporates such as MicroStrategy, which is the poster child for this, but many other companies are now replacing their holdings of treasuries, for example, their excess cash, by holding some Bitcoin. And now in a very recent move, some companies are investing or some of their treasuries into Ethereum and other tokens even. So what's interesting here is that historically Bitcoin's been viewed as a proxy, a levered proxy on the NASDAQ, a very high beta, high risk to the upside, high risk to the downside. But that correlation is actually starting to fall recently. It's now down to about 0.45, which is well down from its 22 highs when it was above 80% correlation. So clearly there's been a maturing in this market. Clearly it's been it's really gone mainstream. I hate to reiterate that, but it definitely is the appropriate word. And if anything, it might even be reducing its linkage with the traditional asset classes, so it could finally be viewed as that effective hedge against other risk assets. Oscar, what do you view? What's your view on crypto and Bitcoin in particular?
Yeah, for sure. I think, as you mentioned in your slide, it's, the way I view it is, yeah, very similar, like digital gold with a tech beta. But I think one thing to be clear here for listeners is it's not a safe haven. And one thing is that it does really well when liquidity is abundant, but it still quite quickly sells off when liquidity tightens. So in my opinion, it's a complementary allocation almost. That's a way to play the liquidity cycle rather than a portfolio diversifier. Um, I mean, for me, I've been on a journey over the last 5 years with crypto, and kind of swinging between the fences on both sides. And it's something like you say, we have started to see a lot more mainstream adoption over the last couple of years. There's no doubt about that. Like you say, 5% of ETF, 5% of Bitcoin's held in ETFs now, right? So um, I am interested to see how it progresses over the remainder of the year. I still, like you say, it's still tagged to the Nasdaq, right? And with my thoughts on potentially, if I was to say the Nasdaq would likely sell off over the next year and a half, I do see Bitcoin falling alongside it, of course. And I think the vast majority of the retail market are very one-sided on crypto right now, which is just that bull story. And for me, I'm not as sold right now personally. But yeah, it's not really something that I trade, especially from a leverage perspective personally. I just spot accumulate Bitcoin whenever I see a dip in price, and I will continue to do that with no aim of selling short term. So I think that would be the strategy which I would point most people towards, especially if you don't have the experience in to be able to really take advantage of these swings, because like we say, they can be extremely volatile both ways. So yeah, that's the way I view crypto personally at the moment. Is crypto something that you trade personally, or are you more sort of buying at spot prices? What's your outlook there, Mark?
Yeah, so for me, well, two things. One is I do want to go back before I get onto my thing. You mentioned leverage, and I would certainly discourage anyone who is involved in a volatile asset such as uh, Bitcoin or any other crypto, as well as any other volatile asset, whether it's any other type of derivative, to not employ any leverage. Only because these assets are already very volatile, therefore you can obviously make a lot of money, but you can also lose a lot of money just in and of itself. So why add that extra degree of complexity where the timing is key if you do employ leverage and you could easily get wiped out. So what we always encourage the people that we talk to, and many of our videos highlight the fact is risk management is key, and leverage in these types of assets certainly I don't believe has any role to play, because you can do very well, or you can also lose a lot of money just in and of itself. So
Yeah.
discourage that. And in terms of me personally, I'm a I am a believer in crypto, especially Bitcoin and Ethereum.
Mm.
Those are the two main ones that I look at. I'm sure there's plenty of other great little alternative coins out there, but I don't have the time at this point to really dig too deep into those. So I've really focused all my attention on on the two big ones, Bitcoin and Ethereum. And I do believe over the medium to long term, they will continue to garner more and more attention. It seems like corporates, as we mentioned with MicroStrategy and others, it seems like governments, the US leading the charge, but there's also in the Middle East, Dubai's becoming a crypto hub. Singapore in Asia is trying to be a leader in that field relative to some of the other Asian markets. So as we get more and more institutional slash government backing of it through regulations, through investing, I think there's only one way. It's the simple economics of supply versus demand. The supply in Bitcoin's fixed. The demand seems to be only going one way, meaning up. That leads to eventually higher prices. However, obviously, we know that it's very volatile. So on a day-to-day, week-to-week basis, markets, the Bitcoin price and Ethereum price can fall. But over the medium to long term, I think it's definitely has a role to play in someone's diversified portfolio, which actually brings us to, I believe, uh, near the end of our
Just
presentation here. I'd like to
just quickly
show.
before we
Oh,
sorry,
sorry.
Mark. Just quickly before we move on. My
Yeah.
question I had for you was, where did you first learn about Bitcoin? Was it something you've been looking at for quite a few years now? I know you've got institutional background. When did
Yeah.
that come across your radar for the first time?
Actually, so I've been teaching mathematics and finance now for a dozen years, and I still remember it. In summer of 2016, the big event that especially our European listeners will remember was the vote on Brexit, where the UK voted to leave the EU. And so that led to a massive fall in the British pound versus the US dollar. It was trading above 150, and in the space of a day or two went to the 130s. And that's basically now, fast forward 8, 9 years, we're back to the 130s. But in the meantime, it almost touched parity briefly um,
Yeah.
a couple years back during the Liz Truss well, well documented, short-lived tenure as prime minister. But in 2016, when Brexit occurred, that obviously led to a big movement in many currencies. And for some reason, Bitcoin popped up on my radar back then because it was an alternative to your traditional currencies pairs like the British pound versus the US dollar. And I still remember it. I was talking about it with my class about how the pound had moved, and on the flip side, you had Bitcoin at $600. Unfortunately, I did not go out and buy any Bitcoin back then, so I'm still kicking myself to this day. However, that's when it first came on my radar. It took me about, I'd say, 12, 18 months, so into 2017. Or so, late 2017, to really look at it. By then, there was a big move up in Bitcoin, so it also had a lot more news flow around it. And that's also when Ethereum popped onto the scene or became much more mainstream. So both of those two big currencies were really the ones that I started focusing on, and so I've been actively involved in it really since late 2017 and 2018 and beyond. So seen a number of these big moves up because it did peak in 2018, then it fell by almost 50%. Then it peaked in 2020, fell again by 50%. And then in 2022, it had another big drawdown. So the key is to stay nimble, but also to not employ leverage, which is one of my big mantras. And so as a result, even though I did suffer some drawdowns during these last 7, 8 years, I never got wiped out, and I'm still living to fight another day and actually benefit. Overall, it's been a profitable trade or investment now at this point. Anything that you're involved in for 7, 8 years, I think, does move from trade to investment category. Most people would agree.
For sure.
So
No, thanks, Mark.
let's finish up here with our with some quick recap and views on where people may want to be positioned going into the latter half of this year. And actually, there's a little bullet point here on the alternatives that we haven't talked about on commodities. And I know that, Oscar, you might have a little thing to say there. So on the equities, as we mentioned, the U.S., even though it's expensive, is supported by momentum in that AI-driven capex. Europe is cheap, but it does have some also nice tailwinds. As a result, the markets have started to reach all-time highs there as well. And then, as we've said, India and China are the GDP growth drivers. And so as a result, as long as they're able to maintain that and maybe even surprise to the upside, they should continue to do well. On the fixed income, as we just spoke about a few minutes back, there's the short duration versus long duration. And as Oscar well said, in terms of the steepening of the yield curve. And finally, on the digital assets, I still believe, and I think, Oscar, you agree, at least from a trading perspective, there's some nice things to be done. But on the commodity side, which we haven't talked about, um, oil and gold are obviously the two big ones. What is your view there, Oscar?
Yeah, so I mean, I still think gold is a strong bet against geopolitical tensions at the moment. I mean, if we dig a little bit deeper into gold, I'm personally looking for bullish positioning for the remainder of the year. I mean, gold is up. I'm just looking at my chart now, almost 29% year to date,
Yeah.
which is driven by US rate cut bets. Like I say, geopolitical tensions, central bank buying, ETF inflows, especially from ING. So we've seen ING revise forecasts higher. average at $3,400 an ounce in Q3, and then $3,450 an ounce in Q4. So I'm still looking for longer term positioning on gold. My only slight concern is we have observed since we've had this, the tariff situation on the scene back since April, gold has just been consolidating sideways. So I do have that in mind, and I am just basically at the moment just trying to play that range as best as possible until we see a breakout either way. And that's one of the risks of, I guess, having one-sided bias for me on this trade is the short-term consolidation if the Fed delays cuts. Otherwise, I think if if there's no delay to cuts, I think there's still a strong macro backdrop to long gold. So I mean, I can show you guys the chart quickly. I am actually in a long position I executed this morning on gold. Pretty straightforward trade, but let me just share my screen now quickly. Hopefully this loads. It seems to be a little bit slow.
Let me just, you got it, yeah.
Yeah, so this is what I was speaking about. I was just checking what we are up here today, so about 29% here. And this is the range which I was talking about, which we're consolidating in. We're on the daily time frame at the moment. So I have taken a long position, and this is a slightly riskier trade to one of which I would usually take. And I like to deploy this, I guess you could kind of call it a mean reversion strategy with a 50% fib retracement, and also our 50 EMA here on the daily time frame, which we've retraced to. And ordinarily on this trade, I would have a much wider stop, right? My stop would be at the low of this Fibonacci level. However, with this range in mind, that trade doesn't really give me, appropriate risk to reward. And I like to, for my personal strategy, I like to have a higher risk to reward level. So it's a little bit more of a risky trade here. However, I think from a macro perspective, the data is more bullish than bearish for gold, and this is a trade which I'm in at the moment. We're in a slight bit of profit at the moment due to the fact that this is slightly riskier, like I say, than usual. My main goal here really is to de-risk the trade as soon as possible, and then see how things progresses. But in an ideal world, I'd like to see a retracement back down to 3270 around this lower bound of this range to look to continue long, and that's if the macro doesn't change there. That's my outlook on gold. I'm not really someone who personally does a lot of trading on oil, so yeah, go for it, Marc.
Yeah, just on the gold front, as you initially showed, basically gold, even though it's been trading in this band now for a little while, is at or close to all-time highs if you really zoom out a 20, 30-year time horizon. The one metal that has lagged gold is silver. And we've done a video or two on silver and have been highlighting that as an attractive alternative to gold. And it's slowly starting to not reach all-time highs. It's still well off its highs, but it's reaching 52-week highs on a bit more consistent basis than gold. So for those that are looking for an alternative play, we have encouraged people to look at silver as an alternative, even though I totally agree with you from a medium to long-term fundamental, gold is a great hedge to any of these macro risks. I think silver is a bit less played out, a bit less covered by most traders and analysts, so that might be an alternative area to focus on.
Yeah, no, I totally agree. Like you say, we are pretty much at all-time highs when you zoom out. A funny story there actually is, the best trade of my career was back October 22, and on the Friday before we had the whole Russia, it was Israel Gaza. I'm pretty sure.
October
was announced that weekend. I went long on gold for a variety of reasons, which I won't get into now. Maybe it's a story for another video, but. That really caught the beginning of this exponential move on gold, which we've seen since then. But yeah, I totally agree. Silver is also a great play for people who are looking to take advantage. Do you do much looking at the gold silver ratio, Mark? Is that something that you employ with your analysis?
Yeah, I do, and that was one of the, we had three or four bullet points as to why we believe silver might start to outperform, and that was one of them. Absolutely, that it's not the only thing to look at, obviously, but it's certainly one of the things to look at, 100%.
For
And
sure.
actually, similarly, the Ethereum to Bitcoin ratio is also something that a lot of investors, including myself, look at after a long, long period of outperformance by Bitcoin since early 2023. The ratio is finally starting to turn around, and that's something that could potentially lead to, even though both assets could go up in price, maybe Ethereum could outperform. So I'm sort of in the same camp as in I believe both silver and gold will go up, but I think silver just might be just a more attractive play at this point in time right now.
Awesome. No, thank you for that. I think that sort of summarizes everything for me. I mean, just as a brief summary of, I guess, what we've already discussed, we've got, Europe offering value, like we said, emerging markets offering growth, and when we look at US equities, they still have liquidity sensitivity that can drive short-term rallies. But my main closing point from me, anyway, is the key for the remainder of the second half of this year is really about flexibility. The second half of 2025 isn't about locking in one view and just forgetting about it. It's about adapting as liquidity and policy evolve moving forward for the remainder of the year. But I'll pass back over to you, Mark, for any final thoughts.
Well, I think we've covered it all. So I want to thank everyone for joining today, and certainly look us up on the various social media channels, whether it's Instagram, YouTube, TikTok, and LinkedIn, especially, but any of the others, we're out there. So hopefully you found this informative, and we look forward to seeing you again in a future webinar.
Awesome. Thanks, Mark, and thanks to everyone who joined.
Great. Thank you.